When I think of what's happening in the office market right now, the term squeeze comes to mind. In finance, a squeeze happens when market pressures force participants to make unprofitable decisions. Squeezes often feature feedback loops that further accelerate the problem. A recent example is what happened to GameStop. Hedge funds bet against the stock, but retail investors poured into the market, buying GameStop shares. This pushed the stock price higher. The upward movement then forced short sellers to turn around and buy the stock to cover their position, thereby pushing the price up even further. Stuck between a market that is demanding flexible leases and an ecosystem of valuers, lenders, regulators, and investors optimized for traditional long-term leasing, office landlords are facing a potential market squeeze themselves. Given the structural issues in the office market, it is difficult to see a simple way to avoid this squeeze without a large loss in value. Like bridges, utilities, telco networks, office buildings are large capital-intensive investments that need to be financed using long-term debt. To reduce the risk to their lenders and investors, landlords try to match their long-term financing commitments with long-term leases. Lease defaults are bad, so landlords look to minimize them by leasing to tenants with high credit ratings. Ideally, the tenants are also on net leases, so operating expenses can be passed on to the tenants and the cash flows become even more predictable. Landlords almost act like banks, accessing money from the capital markets and lending it via leases to tenants who either can't or choose not to buy property themselves. The system is clean and easy to understand from a financial perspective. And with long-term predictable cash flows, commercial real estate behaves very similar to the bond market. So it's no surprise that an entire ecosystem thinks of the commercial real estate industry through the lens of fixed income and therefore highly prize long-term leases. But as Caleb Parker often notes,
I believe that the future of work is flexible, and the future of work equals the future of office real estate.
And with the increased flexibility of how, where, and when people work, the office market will need to follow suit. This change in demand is compounded by the fact that in a lot of cases, occupiers simply prefer more flexibility and services from their landlord. While there's a lot of disagreement about what the exact future of the office is going to be, almost everyone can agree that demand has been permanently scrambled. An often cited prediction by Jacob Bates from JLL is that 30% of the market will be flexible by 2030. Given that the current office industry relies on the long-term predictability of traditional leasing, this is a huge problem. The crux of the issue is how the commercial real estate industry values flexible leases versus long-term leases. So far, the amount of flexible leasing added to the market has been small enough that it could be accounted for by tweaking the capitalization rate. But there is no agreed upon valuation methodology that accurately accounts for changes in the risk profile from a sizable switch to flexible leasing. All of the current valuation methods assume flexible leasing means more income volatility, but that is unlikely to be the absolute rule. Yet valuation incentives nudge landlords away from providing the actual product that the market is demanding, flexible leasing, compounding the problem. Landlords that wish to stay the course and continue to lease traditionally will face the double headwinds of reduced demand from tenants and a growing supply as tenants reduce their current space. Ultimately, this will put downward pressure on rents, forcing profits and therefore valuations lower as well. Valuations are tied to lending through debt covenants. Landlords that cannot maintain a significantly high enough loan-to-value ratio could face additional financial pressures. Valuations also find their way into financial disclosures for publicly traded real estate companies. Because changes in real estate value are reported as income, even if the company has no plans to sell their properties, downward revaluations can turn a profitable operation to unprofitable. On paper, landlords will be faced with a brutal decision. They can either stick with traditional leasing and risk lower incomes, or protect their incomes with flexible leasing but risk lower valuations. Outside of the commercial real estate industry, many businesses rely on less stable sources of income, yet they can still access debt and equity in the capital markets. The difference is that these businesses can quantify the risks they're taking on, allowing the capital markets to price them efficiently. Starbucks and Netflix are able to access the debt market without multi-year commitments from investment-grade corporate customers. So why can't real estate? I expect that the profile of real estate investors and lenders will eventually change in order to match the new risk profile of the industry. I can imagine many offices increasing in value with the new sources of income, but also changing their capital stack to include less debt. However, without a valuation methodology that accurately quantifies risk, we are left with a structural inefficiency in which landlords become squeezed. Meanwhile, demand for flexible leasing continues to grow, exposing trillions of dollars in assets to mispricing. And as with all market mispricing, we can expect an eventual correction, a looming threat for some, but an opportunity for those who prepare. Hopefully this video has been useful and will spur some discussion around the future of office space. I had great conversations with people over LinkedIn after doing my last video. If you have any thoughts on this or anything in commercial real estate, connect with me over there.